Hello, everybody, and a very warm welcome to the More You Know podcast. And we're coming to you this time from the STANLIB Asset Management Impact Conference 2026 at the Bryanston Country Club. Now, this conversation comes out of one of the conference's big themes, whether private market capital in South Africa can deliver not just returns, but real impact, real important, sustainable impact. Whether there is real discipline, whether there is real credibility along the entire energy transition chain and the broader economy. And the brief in this conversation, I think, is very clear. I think investors want some practical insight into risk, into structuring, into governance, and maybe what is genuinely investable right now. And I'm going to introduce my two guests, and then we'll get straight into it. First of all, Johan Marnewick. He's been on the podcast before, head of fixed income private markets at STANLIB Asset Management, along with Karishma Bhoolia, who's a senior climate risk analyst at JustShare. To both of you, a very warm welcome. Johan, let's go straight in if we can. What is investable in private markets right now?
Well, quite a lot, I think, is the short answer. Remembering we manage kind of broad spectrum private credit funds. And in South Africa, there's still a huge deficit of capital, more broadly speaking. The type of assets that we find, by the way, not all of which would qualify as impact thematic or impact assets, but the broad spectrum include SMME finance, agricultural finance, a big theme for us still. Of course, some of the more impact-related themes like energy transition and infrastructure. But broadly speaking, private credit is still a very important mechanism to deliver capital into the wider economy.
Karishma, for the purposes of this conversation, what does impact mean?
So impact means delivering real-world transformation. And in the African context, that's linked to the just transition. We need to look at how we decarbonize our energy markets, and we need to make sure those benefits are equitably distributed in our economy. We have huge inequality problems, and the current structure of the economy is exacerbating that. So when we look at impact, we need to look at how we transform environmentally as well as how we transform socially.
And given pressures on society and pressures on the economy, often impact is going to take second place, isn't it?
It shouldn't be.
Of course, but potentially it can.
Potentially it can, and this is where impact investing, and when we're talking about what impact should look like, it shouldn't be taking second place, because the two need to go in hand. Those risk-adjusted returns need to transform the economy so that we see those benefits along the kind of baseline of society, which is going to uplift everything. So when we look at impact investing, we need to be sure that it's not a tension. And if there is a tension, it's a creative tension, where we look at how impact investing is used to bring up the big structural challenges facing the economy.
So in that respect, then, where do you see the biggest gap between promise and where, I don't even know if I'm allowed to use the word rubber, but where rubber hits the road? I don't know if that's sustainable or not.
Well,
but you know what I'm saying.
I know exactly what you're saying. And I think we need to start from the baseline in terms of disclosure. We are not able to track impact investment because very, very little is being publicly disclosed. We see a lot of good PR around the fact that banks are investing in renewable energy, asset managers investing in social capital, but we're not really looking at what those impact metrics mean backed up by verifiable data. So we're seeing a big transparency gap, and it's a gap across South African capital markets. So we need asset managers to start disclosing more, making more of their impact metrics publicly accessible so that there's much more public accountability and scrutiny that helps ensure that we're seeing real world impact.
Johan, are investors taking this seriously, and are they conscientized to this kind of thinking right now?
Yeah, absolutely. Increasingly, I would say, Jeremy. And I think especially in a country like South Africa, where we've got these gaping, glaring holes in the society where we live, I think it's becoming a bigger theme for our institutional fund allocators. I think the point that Karishma is making, or some of the points that she's making, I would completely agree with, was saying that there are gaps between the way that, I'd say, fund managers are interpreting their mandates, perhaps delivering on those mandates, and the necessary measures as to whether or not how effective these investments are that we look to place into impact assets. Part of the problem is that there's no real global standard of measuring impact outcomes. You heard me say earlier on that there's a broad spectrum of assets that we look at any point in time. Obviously, you want to do that because the more assets you have in any portfolio, the more sustainable from an investment perspective portfolios tend to be. But how do you measure the impact of your investment activity across a broad spectrum of underlying assets? It's not properly agreed. The way that we try and bridge current gaps is through transparency. I'd say it's key for your asset manager to take fund allocators, institutional fund allocators, pension funds, life companies, the like, along for the ride in a transparent manner. Just say, this is why we've done it. This is why we believe it achieves a certain impact outcome. This is how we measure it, awaiting and working with industry to try and define those proper standards.
Karishma, I suspect that you have much to say on global standards.
Yes.
We're going to get there in just a moment. Where are these gaps that you're talking about, though? Can you articulate those for me a little bit more clearly?
Well, yeah, so let me start by saying where they are not, certainly in our minds, and versus instances where we are finding difficulty of applying them. So let me give you an example. We are funding a wind farm, right? In that instance, we think there are very few gaps in measuring the impact outcome of what you're doing. This is a low carbon or zero carbon way of producing efficient electricity into the grid. So I would postulate that there's no measurement issues there. Think of a microfinancier, right? Now we would provide retirement money onto the balance sheets of a microfinancier. Well, okay, they're providing finance often to people who don't qualify, but they often also charge extortionate rates. How do you measure whether that is a big bad capitalist extortionate outcome or whether you're actually achieving an access to finance United Nations Sustainable Development Goal, which is a stated objective? Which one are you achieving? Right, so can you see how murky it can be? And there's an example of where there are perhaps gaps, a quick and easy example.
That's right? A good example. So, Karishma, then, are South African impact managers then keeping up with the global standards of the two of you have just referenced?
The short answer is no. And I mean, Johan is smiling because hopefully he knows that that's true.
Yeah, it is true.
And if we look at, JustShare did some benchmarking around this, and we found that European managers in particular fare the best. And we kind of were thinking about why do you think that is? And that speaks to the lack of standardization. European capital markets have much more clear definitions around what quantifies sustainable finance, what quantifies social impact, what quantifies environmental impact. So managers know what they need to, how they need to structure their capital, and investors have much more clarity around the fact that that capital is being responsibly deployed. So when we look at this transparency gap, there's a transparency gap and there's a policy gap. So we need different players in this ecosystem to work together. We need the policy frameworks to come and mature and ensure that managers have better clarity. So they know where they're putting their capital. And we as civil society can hold you accountable.
So the policy frameworks are there?
Our policy frameworks are not there yet. Our policy frameworks are vague, they're fragmented, and they're definitely not standardized. There's good intentions in policy, but there's not prescriptive frameworks. And when I say prescriptive, I don't mean restrictive. I mean there needs to be clarity. If you're funding a social impact fund, you need to know what those social impact metrics are, what the deliverables are, what the time horizons are. If you don't know that, you can't call that social impact. And similarly, you can't call that environmental impact if you're not clear on what those impact metrics are. So we don't have clarity on what impact metrics are in the South African context yet.
So how do you find a better lock to make sure that it sticks?
I mean, this is where we need to look at interconnectedness, working beyond just the manager, right? So we need to look at policy certainty. So you had Treasury here. There needs to be much more policy certainty. And from a policy perspective, as well as a private capital perspective, there needs to be much more transparency. So leverage transparency to help civil society hold you accountable. If there's more in the public domain, civil society will tell you, this is fair, this is not fair. Are you accounting for a wind project, for instance? It definitely makes sense from a low carbon perspective, but does it make sense from a community development perspective?
Or from the rest of the environmental impact perspective? Yes, am I allowed to just chip in?
Yeah, go for it.
Please do.
I mean, if anyone's been recently to Jeffreys Bay, beautiful place, but my word, there's a lot of windmills there. And you kind of wonder, has it been properly thought through? There's always more than one dynamic. And this is where those of us that channel funding from the retirement industry into the real economy, sometimes it becomes a very complicated question. I mean, some of these metric and policies are not in place in South Africa because there might have been other higher priorities. In the interim, we need to work together with advisors, people who do obsess about the different layers of looking at a potential downstream impact, again, consequence of putting money to work into a particular asset.
So what would constitute a win for you in terms of better policy certainty? What do you want?
Policy certainty?
Yeah.
We definitely want clear metrics on impact. So when we're talking about, there's always a tension between economic and social development versus environmental impact, and we're always kind of framing in the South African context.
Don't those metrics change all the time depending on projects, though?
I mean, yes and no. There needs to be a minimum set of standards where if we're looking at, say, energy markets, for instance, we need to be sure that those align with our nationally determined contributions and we're not locking ourselves into any kind of fossil fuel-based economy. So when we look at energy resilience, that needs to be there. But there also, when we look at the just transition aspect, there needs to be social capital put in there. Are we ensuring that the jobs that are going to be lost by not funding things like fossil fuels, are we doing skills development? Is there capital available for social resilience? So when we look at what policy needs to look like, those should be your baseline. Yes, there'll be variance within projects, and private markets have a lot more scope there in terms of how you structure that. But there needs to be a minimum set of standards that are linked to clear decarbonization as well as clear social upliftment and development.
How hard are you pushing for those kind of minimum standards?
Yeah, I think we're at the beginning, frankly, Jeremy, of that journey. In the interim, as a fund manager, we hold ourselves to account through transparency in the relationship with our investors and transparently saying to them, look, this is what we're investing in. These are the SDGs that we're looking to achieve. And we accept that for now, we are working to some extent in a void, but we are engaging with policymakers. We are engaging with people who influence where policy may go. And we're at the beginning of that journey, frankly.
It's about, Johan, transparency, but in your world, it's also about return on investment.
Yeah.
I mean, that's why you're sitting here.
Yeah.
How do you protect returns without diluting impact?
Yeah, there's obviously a balance, and there's a conflict between the two, and there's a balance to be struck between the two. Philosophically, how we approach it is, as a large institutional manager, we have statistical models that measure risk. They are based on credit metric, not unlike what rating agencies may want to do. So we measure risk on the underlying, and what we want to ensure is that the returns that come out of the underlying asset still rewards our investors for that risk. Some of the magic that we add into the mix is obviously you can put a portfolio together where you can diminish the portfolio-wide risk. So in other words, risk at a portfolio level could be lower than at an underlying constituent asset level, because different assets could diversify one another. So the risks, in other words, don't act in unison. They're complementary in the sense that the portfolio becomes a little bit more robust.
That's really getting into the black box here.
I mean, this is the magic, of course. Whether or not we get it right, we don't always do that, but we most often do get it right. And I think the point there being is, for the proficient portfolio manager, there is an implied impact benefit meaning the pricing that you demand for individual assets may become lower if your portfolio is diversified and well constructed enough. And therein lies the nirvana of what we can promise.
So what is your clearest test then, Karishma, for impact credibility?
There's three things.
Yep.
The first is a public impact framework. You need to be able to air everything publicly and allow public accountability on it. The second is impact accountability in deal structuring. There needs to be clear mechanisms for accounting for non-impact performance. There's always mechanisms for non-financial performance, but those need to be the same for non-impact delivery. And the last three is proof of additionality. STANLIB is talking a lot about using blended financing mechanisms. We need to be sure that development capital and public capital is not being used to subsidize projects that are bankable on their own terms. We need to make sure that STANLIB is ensuring that the projects that they class as impact investing are delivering that real world impact, and they're doing it where the money needs to be channeled.
So just a quick concluding question to both of you. Johan, institutional investors then, in practical terms, how should they be thinking right now, having listened to the two of you?
Jeremy, if it's not clear, it is complex, some of the balance that we're looking to strike. And my request to the market is to stick with your large institutional managers who are able to give effect to some of the promise that we've just discussed here. You need governance in place. You need independent views in your investment process. You need statistical models. You need risk managers. This is expensive.
Karishma, on the flip side then, what's the warning you'd give them?
My warning for all institutional investors is to not lapse into complacency. You need to hold your manager accountable. Sure, you're able to crowd in a lot more and you're able to trust a big institutional investor, but trust needs to be verified. So hold your managers accountable, check that they're delivering the real impact that they're saying these funds are going to deliver.
Nice, spicy conversation. Thanks to both of you. Karishma Bhoolia, Senior Climate Risk Analyst at JustShare, and sitting alongside Johan Marnewick, Head of Fixed Income Private Markets at STANLIB Asset Management. To both of you, thank you so much for joining us on The More You Know. STANLIB Asset Management Pty Limited is an authorised financial services provider in terms of the FAIS Act. This content should not be construed as advice.